Private credit just flashed a warning sign, and most investors aren't paying attention. Blue Owl Capital just unloaded $1.4 billion in loans to raise cash, not to invest, but to pay out investors who want out. I recommended Blue Owl in my earlier series of 60 dividend paying stocks. I bet you didn't know. Private credit has been marketed as the safe high yield alternative to stocks and bonds. Steady dividends, access to private deals, less volatility. But here's the problem: private credit funds lend to junk rated companies, and those loans are hard to sell quickly. That works fine as long as investors stay patient. Now redemptions are rising. In fact, inflows into semi liquid business development companies have dropped about 15% recently. The biggest fund managed by Blackstone saw monthly inflows fall almost in half. That's not panic, but it's not confidence either. Blue Owl sold loans at nearly par value, which sounds good. But when a fund sells 30% of a portfolio just to meet withdrawals, it raises a bigger question. What happens if redemptions accelerate? Private credit works when capital is sticky. Retail investors are not always sticky. The takeaway: when an asset class becomes popular with individual investors, liquidity risk becomes the real risk, and private credit may be entering its first real stress test. What do you think? Leave a comment.